Major uncertainty on Wall Street this week. On Wednesday, the Federal Reserve is expected to announce the first interest rate hike in nearly a decade.
And oil prices have dropped to their lowest levels in more than 6 years. Yahoo Finance columnist Rick Newman is here to discuss the impact. Rick, thanks for being with us. Can you just explain why is it that the markets are expected to be so volatile this week?
Because the Fed is everything in the markets right now, and this is a historic moment. First time they'll be raising interest rates in 10 years. It's a directional change. Now, we've been anticipating this for so long that there may be no mystery around it. And it's quite possible the markets have sort of built all their expectations into what the Fed's going to do, and things will calm down a little bit, but we just don't know until they actually do it.
Rick, what could the impact be on the American household, and why should the average family care?
I think the impact's going to be a lot less than everybody thinks. We keep talking about this as if it's Armageddon, and we're talking about the Fed raising short-term interest rates by 1/4 of a percentage point. We're still going to have really, really low interest rates. So the real question is whether markets freak out about this. And if that's what happens, which has sort of been happening, then we will, people will see their 401k plan losing value. Basically the stock market has been flat all year. It's down a couple of percentage points. That's partly because we know this rate hike is coming. And again, it's more that it's a directional change. That's really more important than the, one single rate hike. But at some point, we need to digest this. You can't have 0% interest rates forever. We need to digest this, get on with things, and figure out what's going on in the real economy and stop talking about the central bank.
What about lower crude oil prices? Because, on the face of it, that sounds like a great thing. Why is that a problem?
It's a problem because energy prices have fallen too far, too fast. And markets are interpreting that. They've gone beyond interpreting that as that's a good news for everybody who needs to buy energy. And they're interpreting that as bad news because demand is so low that it must signal problems that are worse than we realize. Now, there is a lot of oil supply in the markets right now, and I think it's just not clear. Is this a situation where there's just so much supply, or is it that energy users have cut back so much because there are big problems? We're trying to figure that out. Meanwhile, everybody should enjoy cheap gas prices because they are really low.
Yeah, they really are. Rick, is the U.S. economy weaker than the stock market might indicate?
Well, I think the stock market might be weaker than the economy indicates. Remember, again, we've had a flat market this year, down a couple of percentage points. And yet we've been averaging almost 200,000 new jobs each month. More people are going back to work. People feel better. Layoffs are way, way down. They're almost at record lows. If you have a job, your job security is pretty good. That has not been reflected in the stock market this year. And I think the Fed is a big part of it, which is why, again, we need to get back to something that feels more normal than 0% interest rates. Start raising them a little bit. Interest rates might go from 0 to eventually, within a couple of years, 2%, 2.5%, maybe 3%. That would be normal. Those are not high interest rates. That would be normal. So we need to get back to normal, and we don't really know what normal is at the moment.
All right. Excellent point. Rick Newman, thank you so much.
Sure.